Fantastic. Excellent. So good afternoon, everyone, and welcome to our session about who's going to pay for all this. Who's going to pay for financing the energy transition, for overcoming the challenges and investing in the financing opportunities on the whole road to decarbonization and a low-carbon economy. And as I said, as Andrew introduced, I'm Louise Pierce. I'm the managing partner for the mining sector for ERM. If you don't know ERM, we're a global sustainability consultancy. We're the largest pure-play consultancy, and we have a tremendous amount of work in the mining and metal space. So our panel, it's going to aim to explore how we're going to finance, the minerals needed for this low-carbon economy transition. And joining me today, so on my right, is the Honourable Minister George Pirie. He's the Minister of Mines for the Government of Ontario, which is also where I happen to live, which is fantastic. So we've got two Canadians. Next to Minister Pirie is Ross Bappu. He's a Senior Strategic Advisory Partner at Resource Capital Funds. And besides Ross everyone's out of order here, Ignacio del Calhoun. I'm terrible, I'm sorry, I tried. But Chief Investment Officer at the IFC. And then next is James Richard, an equity analyst at Fidelity International. And last but not least is Dean McPherson, who's the head of global mining at the Toronto Stock Exchange, TMX. So as the world transitions to a low-carbon economy, the demand for renewable energy and energy storage is going to continue to increase. They say exponentially. And enabling clean energy technologies to grow at the pace and scale needed will ultimately depend on the rate at which the critical mineral resources needed to build them can be found, financed, and mined. And with this in mind, panelists, I have a few questions for y'all. And after which I'm going to return over to the floor and we're going to have a little short Q&A. So get ready for those questions. I'll take one or two at a time. So the first question, I'm going to come to you, Ross, first. So what commodities do investors currently find attractive in the short term as good bets for the energy transition? And then how about the longer term?
Look, I'd start by just saying that as a private equity fund representing resource capital funds, we typically invest at a 5-year time horizon. So we're looking out sort of 3 to 7 years and evaluating what is the market going to look like for commodities at that time. We've been around for 25 years, and over that period we've invested in some 30-odd commodities at all stages of development. Of course, when you look today, the energy transition, the decarbonization activities that are projected, the focus is all on a particular set of commodities, and so that would start with copper. I think Mark Bristow was talking about the demand for copper. It's going to increase at just an amazing rate, and so copper, we're very keen on copper. But in addition to copper, we like metals like nickel, cobalt. Cobalt's hard to play. Nickel's hard to play. Zinc. Zinc's a really interesting commodity. It has a lot of potential. We see some short-term softness, but longer-term some pretty good excitement around zinc. And everybody talks about lithium. I think lithium. There's a lot of lithium out there, but there's not a lot of lithium downstream processing capabilities. And so, from an interesting place to play, I think it's that downstream processing, refining when we look out, looking forward. So, the other thing I'd say is we're quite opportunistic. We still like precious metals. We like gold, silver, platinum group metals. Those are always interesting, but on an opportunistic basis. But clearly, the energy transition, the decarbonization activities drive the way we're thinking about what we want to invest in the short term.
Fantastic. And James, do you want to pile on to that?
Yeah, I think what's often overlooked is the breadth of commodities that have their demand trajectories long-term impacted by the energy transition. And also the way that innovation is going to drive those demand trajectories going forward. And so it's for those reasons that, the commodity is important. But I think particularly, this is very much a sort of small cap conference, particularly at the small cap end of the things, other things are more important than just the commodity, by which I mean asset quality, some of the key sustainability criteria, and how mining friendly the jurisdiction in which the resource is. A patch of land with a great commodity and great mineralogy. If you don't produce from it, it's just a patch of land.
Right. Anyone else want to talk about? No. Okay, let's keep going then. Okay, so we spoke a little bit about downstream lithium processing, but what opportunities are investors looking at when it comes to financing the critical minerals? Is this Greenfield? Is it Brownfield? Is it exploration? Is it production, downstream investment? Are there certain geographies for anyone? So Dean, I guess in the TMX you must see a lot of variety of what's coming up with startups. Maybe you can go first on that one. So where are the opportunities and what are investors looking for?
Thanks, Louisa. Yes, I do think that investors are focused on jurisdictions that are stable, predictable. The usual. Certainly, when it comes to the choice between Greenfield and Brownfield, we're not really seeing any difference in appetite and attractiveness. Certainly, one of our more stable and predictable and investor-friendly jurisdiction in Canada. I'll say it's Ontario because George is here. But in addition to Ontario, I will also say Quebec has been quite outstanding in everything that government is doing to attract investment into the province, and certainly we've seen a lot of projects that were, for whatever reasons, left startup and left a few years ago, 10 years or 15 years ago, are now back on top and getting quite a lot of attention, and certainly seen a lot of money flowing into developing those projects. The Namaska project jumps to mind in Quebec. So definitely, I think what's the key driver in terms of where money is going in the energy transition effort is really around jurisdictions that are attractive for investors, and we all know beyond the concerns around how those jurisdictions entertain mining, or shall we say, welcome mining companies also. But relationships and social license issues as far as indigenous people are concerned in those communities are factors as well, because that also adds to the predictability. And I would say lastly, the other factor is what are the governments doing to help investment in those jurisdictions in terms of tax relief. In Canada, we've seen the Ontario government certainly have taken some significant steps recently to encourage development in the lithium critical minerals sector, subsector, and of course I mentioned Quebec earlier. Speaking wider afield, you'll see in LATAM, which is a lot of our issuers outside of North America, Latin America tends to be a big jurisdiction for our companies and investors' participation. We see initiatives like, on the one hand, Lithium Valley in Brazil, which is being brought together as a sort of investor welcome feel, encouraging investment in the lithium space. And Argentina, I would say, falls into that category as well. Now you see countering moves in Chile and Mexico, where people sort of have had an interpretation of less inviting, less welcome environment. So there tends to be a pause, particularly in the case of Chile. Investors have been trying to digest the government's move around lithium in particular, and how they're going to approach investment, attracting investment into that space. So I think those are the factors that are really driving investment direction, and I think you expect to see that continue.
Excellent. Ignacio, you must see a pretty global view on these things.
Yeah. We're a bit of a weird fish. For those who don't know, IFC, we're the private sector arm of the World Bank Group, and our mission is to invest in private sector projects and companies in emerging markets, including obviously in the mining space, and we do that through equity, debt, mezzanine, or any instrument. So we've invested and mobilized about $6 billion of investments into the mining space in the last 10 years, roughly. And if you look at that, our current portfolio, it's heavily dominated by copper. About 45% of our portfolio is copper, and we've got around 10-12% in lithium and other commodities. And I think our mission is actually to go to the places which are more challenging and try to see how we can develop those projects, and then to James' point, make sure it doesn't just stay as a piece of land, because sometimes it does. Yeah. But they're really the analysis that we're doing, and I think to your point is, yes, it's a bit about the commodity, but it's actually about the management team, the quality of the assets, how they develop in terms of the local environment and their standards, so that we have confidence that asset actually will be developed and will be developed responsibly. So we're looking, I think, across the commodity spectrum and in all these geographies. I mean, some of our more recent investments we did earlier this year. We put together a $180 million financing package for Sal de Vida, a lithium mine in Argentina. We just did and co-led the $4.4 billion refinancing of the OT project financing with Rio in Mongolia. So just to give a few examples, and we've got a heavy exposure in Guinea, for example, and in other places. So these are jurisdictions where you need strong partners. You need concerted efforts in doing this. So that's what we're looking at. I think we're also interested in, to your point about the downstream. We have the ability to invest in other subsectors or sectors which are actually supporting the mining sector in the decarbonisation journey or in the circular economy. So that's something we're very intent in doing. So we recently, for example, in Chile, we provided a $400 million facility to Engie, the energy company, so that they could decarbonise, increase their renewables, and the majority of their customers are mining companies in Chile. Or in the circular economy, we've just invested $90 million in a company called Elemental Holdings in the Polish base, but have global operations. They're urban mining, a company looking at recycling of e-waste, etc. So looking at that end of the spectrum as well. And then we also have a VC arm who is investing in new technologies. So we just invested in a company called Boston Metals that's looking at new forms of doing green steel and others. So I think all that to say, we're spreading our bets, it's fair to say. We're a long-term investor. I mean, we're looking, in some cases, looking at 10, 20, 25-year horizons. We have no clue. I mean, our battery composition is going to completely take out nickel. Is silicon going to substitute graphite? Haven't a clue. Don't know. At least not in the next 20 years. Maybe you can do some forecasting in the next 5 years. So at the end of the day, we do have to spread our bets, because we're not sure. There's one certainty: the world will continue to decarbonize. How exactly it does it over the long term, there's still a lot of uncertainty. So, that's sort of how we're seeing the world and this space.
Can I just pick up on that? Because I think it's a really good point, and sort of the long-term uncertainty. And, you talked about Greenfield versus Brownfield. And this is, everybody talks about demand, but this isn't just an attractive thematic because of the elevated demand. It's because supply, globally has never been so difficult to bring on as it is today. And so the risk premium around a non-producing asset is relatively high. It doesn't mean that they're not investable. It just means that the bars that they have to jump over are higher than for a producing asset, in my view.
I might just add from
Go ahead.
From our perspective, one of the critical issues is around permitting today. The permitting regimes across the world are so variable and can be so challenging that we really focus on projects that we can put into production in a finite period of time. And to do that, you have to have projects that are either the permits are in hand or they're coming with a high degree of certainty. So that plays very heavily into our decisions, and for that reason, a lot of time brownfield projects make sense.
Very good. Actually, we have a study coming out on Thursday that is an update of one we've done twice now, starting in 2008, and it looks at, I think we looked at 112, projects this time. Permitting delays are the number one cause of delays. And
such a problem.
A lot of factors that go into that, but it's a challenge, for sure. All right, Mr. Peary, I'm going to come to you because Ontario, it has such an abundance of critical minerals and a really unique combination of old mining camps that we both know well, yourself especially, and new areas to explore. So what opportunities and challenges does that bring for Ontario, and how do you attract investment into Ontario? How's that going?
That's going very well. If I could back up a little bit about
Yeah.
jurisdictions, and just 5 years ago, we're looking at a situation where we had lost 300,000 jobs prior to getting elected, and in 5 years we've attracted 700,000 new jobs into Ontario. How do we do that? Well, we get back to basics. We cut the WSE charges by $2 billion, and then we gave $1.5 billion back to the companies. We saved the companies have saved $1 billion in accelerated depreciation. We've reduced income tax by $450 million. We've through red tape reductions, we've saved over $400,000. We've cut energy prices down by 15%. So, and on top of that, we got a green grid. So, you know, the ministry doesn't build mines, but we set the table. So we start there. We released our critical mineral strategy about 2 years ago now, about 20 months ago, I guess, and it focused on six pillars. And there's a couple of them here that we want to talk about that we've mentioned. We talked about exploration. Well, the Ontario Junior Exploration Program, that's up to $35 million. It's a program that's working. Ontario is the #1 jurisdiction for exploration in Canada. You talked about permitting. Well, that's one of the pillars of the critical mineral strategy, and that's an act that I'm very, very proud of. That's Building More Mines Act that got royal assent in May of this year. That's record time to get a bill through. We're building out the regulations right now, and that's all about permitting. I decided to run for the provincial government because we had a gold mine in about 60 miles south of Timmins, and it took close to 17 years to get the mine permitted. It took the provincial government to assign a senior environmental advisor to ensure that those permits got done. So what are you left? You're left with a project that they're spending $2 billion. There's 1,600 people employed south of Gogama and camps. The First Nations are fully employed, Matagami and Flying Post, and you're building a mine that doesn't even discharge water. The new act that I'm talking about, there's two things, and I'm very proud of it. I'm proud about that. There's not a word in the new act that's different than the old act in relation to two different points. Ontario's world-class environmental regulations and the duty consult. So that speaks to the type of the beliefs that we have in relation to into mining. We're transforming from a fossil fuels economy to a battery technology based economy. You know, we can't say we're going green if our mines are not green, and they are. You know, Vale spent $1.5 billion eliminating all emissions from the superstack. $1.5 billion of their own money. They went on. They're developing the Coppercliff mining complex. Close to spend $1 billion, and it's in all EVs. It's all electric. All the scoops and trams. They'll be spending another $900 million in the Creighton project. Same as Glencore, just at the Nickel Rim mine, and again all electric. An exploration program called Canada Nickel north of Timmins. Their fleet will be powered by hydrogen. We've got probably 1,000 years of natural gas, and in Canada, where we've got so much natural gas, we're not looking for it. We got an empty pipeline in Northern Ontario that's used to have carried natural gas. It isn't now. You burn natural gas, you create CO2, but we can sequester the CO2 with serpentine. So you know, we should be a hydrogen superpower. So We've got a green grid. We've got all kinds of opportunities to expand that green grid through small modular reactors, which is another initiative that we're very proud of in Ontario. We'll have a large portion of hydrogen, and of course we've got abundant hydroelectric power. So as jurisdiction goes, I think we're doing very well. We've got an innovation fund that we just announced a few months ago. It's oversubscribed. We'll be expanding that. We're happy to see that the federal government has announced they've matched the, they're about $1 billion into that fund. And as you know, the province announced $1 billion to kickstart the development in the Ring of Fire. And that's all about infrastructure. It's broadband, it's roads, it's building capacity with the Indigenous communities. And we've got fantastic partnerships with the Indigenous communities. The EAs that are being conducted right now in the Ring of Fire, they've been running by two communities, Webequie and Martin Falls, and that's the way it should be. They're conducting the duty consult with their communities because that's where they are. I mean, it's those resources are in their traditional territories. So as jurisdictions go, I think Ontario is operating on all cylinders. I think we've got a strategy that's designed to secure the supply chain, and I think the world really knows, especially with the illegal invasion of Russia into the Ukraine, exactly how fragile that supply chain is. And it's incumbent on us, especially in Ontario, to secure that supply chain. We want to have the metals, the critical minerals from Northern Ontario matched with the manufacturing might in Southern Ontario, and we've attracted over billions of dollars of plants in Southern Ontario. So as a province and as a jurisdiction, we do think that we're the #1 jurisdiction for investment globally.
Fantastic. And maybe just going on those two themes of investment and other investment vehicles, if we can go down the panel now, I'll start with Ross, but what else is out there? What are you seeing in other jurisdictions or that would either expedite permitting or help in the investment case?
Well, it's an interesting dilemma. We're seeing, for example, in the U.S., the federal government is pushing very hard for development of new critical minerals, but yet at the state level, we have a lot of tension. And so we find that we're getting support, whether it's financial or from a regulatory environment at the federal level, but at the state level, it hasn't caught on yet in the U.S. So we have a nickel mine we're trying to develop in Minnesota, for example, that received money from the IRA, $114 million, but yet it can't get its permits in Minnesota to build the mine and processing facilities. So they're looking at processing in North Dakota, which it just makes no sense. They're shipping jobs to North Dakota when they should be in Minnesota. So that sort of thing is very frustrating. Look, I think we're seeing a tremendous amount of money flowing in, whether it's the U.S., Canada, the EU, into critical minerals, and that's extremely healthy. Where I think there's a disconnect is that the public markets aren't being equally supportive. So the federal money typically will fund up to 50% of a project, which means the company has to go out and raise the other 50% from elsewhere. And we're finding that raising that money elsewhere is a real challenge. So from our perspective, having private capital, it's great. I mean, it creates great opportunities. But for a lot of companies that are looking to those public markets, the Toronto Stock Exchange or the Australian Stock Exchange, raising money has not been easy. And so what we're seeing regulatorily is fantastic, but what we're not seeing is the market responding in a sort of equal way.
That's good. Maybe I'll skip over to the end there to Dean. I mean, the markets aren't responding, even though the demand and the future's there. What's going on with the sentiment of folks?
There has been a lot written and spoken about on this topic about the lack of equivalent or expected participation level of investors in the space, particularly energy transition space. But I'm often quick to caution and remind people that we are in a down market generally. Certainly 2021, we had an outstanding year. I would characterize that year as a bit of a transition year for energy transition. mining sort of came out of the shadows of the villain and suddenly was seen as the hero that will take us to our global ambitions for emission reduction targets that we were talking about 2030, 20 and 40, something like that. So suddenly mining, rightly so, has been identified as the vehicle to take us to the energy transition path to achieve those goals. So since then, however, 2021, which was an outstanding year for capital raise in the space, we've had significant issues. Things have happened in the world, and those things have played out in the equity capital markets, and we've seen a significant slowdown in equity markets in general. So I think that's the context that it's important to keep that in mind. That being said, capital being raised right now in our markets tend to be focused on energy transition metals, critical minerals, uranium, copper, and lithium in particular. But as someone pointed out earlier, the other critical minerals are also coming along quite well, nickel, etc., especially, I would say. So, yes, equity participation is not where it should be, considering the fundamentals, but I think the major issue is the constraint of economic challenges globally, the two significant world events happening in Ukraine and the Middle East. I think those are having a bigger impact. Ongoing, however, we see it as our responsibility to promote the sector, the mining sector at the TSX, because we are at the crossroads of capital, companies seeking to raise capital to realize shareholders' goals. So we do have a responsibility, and we certainly take it seriously within the exchange, within the TMX group, to promote the sector. And one of the things that we've done 2 years ago, we realized that retail investors in particular needed to become more aware of how critical mining is going forward, particularly in the critical minerals and energy transition initiatives. And so we created an index, which was the Energy Transition Materials Index. And we're happy to say in September this year, BlackRock launched an ETF based on that index. And the idea really is to give retail investors who typically tend to tiptoe into the market under these ETF vehicles, passive investment vehicles, an opportunity to participate in this phenom, the energy transition phenom, because we do believe once the external factors subside, and we're certainly having a lot of optimism with interest rates taking a pause and perhaps even going the reverse way, we do think the market will come back. And so what we're telling investors is become aware and be exposed to the different methods of participating in the market when things are right. And we think that's maybe 3 months or so away. So yeah, we do think that education is helping, and certainly attend conferences like this and bringing this message and knowledge that's discussed here out to the broader investor base helps a lot. And as I said, we'll see what happens over the next year or so, but I often say, please don't forget that we are in a constrained equity markets globally. So, but I do think people are getting it.
No, it's really good points. I mean, I guess, so it's bad, but not that bad, and actually pretty well performing considering. Ignacio, James, anything to add on to that in terms of what you see for either investment vehicles or methods or permitting expedition?
I mean,
well, go ahead.
Market demand.
Well, I mean, it really comes back to what I said about non-producing assets and the risks surrounding those. And so if you apply a filter where you're looking at the best assets, and then you apply some of the filters we talked about in terms of permitting, you'll shrink your pool of really attractive opportunities becomes much smaller. And so that's where governments come in to sort of change some of the risk profile a little bit. But there is a tension between the world's need for all of the critical minerals that they can get their hands on, and investors need to make a return on their investment.
Yeah.
And those things are not 100% aligned. And that is something that we need to work through.
No, I mean, the only thing I would add is, I think from our perspective, who we co-invest it with has become increasingly critical. And I think and that's really a key part of our decision making is who else is in the shareholding of this company. We're always a minority investor. We can 15-20% stakes in companies or projects. But we're more and more focused on having like-minded investors with us, investors who understand the mining space, investors who are longer term. I think the public markets are fantastic and can give a lot of liquidity to investors, but there's a mismatch in terms of the time horizon of many investors in the public markets vis-a-vis the life cycle of a mine development. And that's something that has always sat, to be honest, uncomfortably with us. And so I think that's sort of something that we've been trying to sort of see how we get around it, how we co-invest with like-minded investors so that who have that longer-term horizon that can provide those incentives and that sort of gentle nudge and encouragement to the management teams to look at that longer-term picture and not just look at the next sort of news release that has to be out to sort of prop up the share price, because that can be very disruptive, distracting, and actually lead to wrong decision making. So I think that's something that I think we've shifted. At one point, we had a very large portfolio of listed juniors in sort of 30, 40 positions. I think we've sort of moved away from that sort of broad approach and focusing much more on partnering with private equity firms, majors, others that have that longer term view, and sometimes those are listed companies, but co-investing with those types of institutions.
Yeah, very well said. Audience, I'm going to come. Is there any questions that are popping up yet? Okay, great. Andrew, this gentleman over here has a question. So,
thank you very much, everyone. My name is Baba Jalal. My company is EMCA. We work on investments coming into Nigeria in the mining sector. There's a bit of an elephant in the room, I'd say, really, because I've enjoyed everything that's been said. Africa hasn't been mentioned, and obviously Africa is not a country. Coming from Nigeria, I know, Ignacio, you were talking about IFC, you spoke of Guinea and Chile, yo hablo español también. I love the whole South American link. And Dean was also talking about TMX and putting investors in, a position to help understand the mining sector. And also, Ross, you were talking about regulatory and permits. Yeah. So we just had the Honourable Minister speaking solid minerals here about, obviously, they come into Nigeria, doing business in Nigeria. What do we need to be quite candid, please? What do we need to do in Nigeria? Where do you see Nigeria now? Because we're not quite decarbonisation, not that level yet, but obviously we have a lot of lithium, we have a lot of gold, we have precious metals, semi-precious stones. What can we do as consultants to invite or attract the right kind of investment? George, you spoke about on Ontario, you put a lot of money into private sector, but our government, we don't have those resources. So what can we do? Where are we at? Can we have some advice on that, please?
It's really good. And who would like to take that one first? But I think it's really important. Africa is a tremendous wealth of minerals and can help. So
I'm happy to start from our perspective. I mean, Resource Capital Funds has been very active in Africa. We've got current investments in Guinea and Burkina Faso, in Botswana. Those are current investments. We've had a lot of investments in other parts of Africa, and we've had good success there. What I would say, though, is that Nigeria specifically, we haven't seen the opportunities from the junior exploration sector, and so it's typically a small company, a junior exploration company that goes in, makes a discovery. And that's the time that we get involved. Post that discovery, once some engineering work is done, where we like our money to be used to build projects. And I guess personally, I haven't seen a lot of the activity that's going on. I'm sure there must be a lot though, and we're just not seeing it. So we just need a better way to be exposed to the opportunities that exist there. But we're very happy to invest in most parts of Africa.
I mean, personally, in my career, I've invested all over in Africa with Placer Dome and Breakwater and on different boards. And I think there's every time that we talk about investing in any jurisdiction, it's an analysis of risk. And whether it's country risk or sovereign risk or body risk, that's the chief thing that you analyze is the risk. And sometimes you get it right, and sometimes you get it wrong. I mean, we had a project in Tunis that it was at the end of its life, but we had a couple of good years there. And in my perspective, I thought it was a great country to invest with. I was at Breakwater at the time. And at the end of the day, it ended up being the first country that was turned over, if you will, with the Arab Spring. And again, from our perspective, Tunisia would have been one of the best jurisdictions to invest with. So, things change in a dime, but it's all your assessment of risk.
If I can just add to that, just to say, in terms of the continent itself, investors in who participate in our markets, and certainly the largest mining market, we are. Africa is an extremely attractive jurisdiction, and certainly one that's well understood for all its challenges and opportunities. This year, our largest IPO on the TSX was Allied Gold in a very tough market. I would say probably the bottom of the market for this year. In August of this year, Allied Gold raised over $300 million through our markets, through a new listing on the TSX. So all focused in Africa and precious metals in Africa. So Africa itself is a very known and comfortable jurisdiction for our investors. In the DRC, there's Ivanhoe Mines, which, going back to copper, built one of the second largest copper producer, I believe, in the DRC, recently went online. So a very attractive jurisdiction. I think as far as Nigeria is concerned, I think investors in our market probably see Nigeria as an oil and gas opportunity. If anything, I think in terms of what you can do to enter the energy transition space is marketing. More of what you're doing here, perhaps participate at PDAC, the world's largest mining convention next March. Perhaps having a larger presence there to market and inform investors about the opportunities in lithium in particular. Because up to this point, I think Nigeria is known as oil and gas play. So if that's changed, it's just doing more of what you're doing on a larger platform like the PDAC.
Yeah, great, thanks, Steve. I have time for one more question. If there's another question from the audience.
If there's no other question, I think there's a source of funding you haven't mentioned, and that's the offtakes from the auto companies directly investing in the critical minerals projects. Mm-hmm. We haven't seen that since the days of Henry Ford investing in rubber plantations in Brazil. And that's simply because the time frame for an investor to get a return on their investment is too long from the point of view from exploration to development. We're doing this in a heck of a hurry and changing from a fossil fuel economy to critical minerals economy. And it is going to take a certain period of time. We've got magnificent critical minerals projects in Northern Ontario, but once they get to the stage that you have some sense of stability vis-a-vis a pre-feasibility or a feasibility study that's bankable, you get a lot of interest from the auto companies or battery companies that are moving directly into investment into those projects. It's interesting. Tex, I think it's been completed. Maybe it hasn't. The sale of their coal assets, and so that's a fairly large company that's moving dramatically into critical minerals, and again with about $8 billion or U.S. that they want to see directly involved in critical minerals projects. We we've seen the absence of that over the number of years in the mining community, where major companies regularly used to migrate down to the junior companies, and we haven't seen that happen, but in a number of years aggressively. But it looks like tech is doing that right now, which is, I think, a welcome sign for investors, especially in the critical minerals sector. Yeah, it'll happen, and it's going to take. It's going to happen quickly, and so I think there's a couple opportunities to mobilize capital that hadn't been mentioned, but I think those are two significant ones, and we see them happening in Ontario.
I think the other one is Exxon going into lithium.
Yeah.
Big announcement.
Yeah.
So
There you go.
the oil and gas companies used to be in the mining business back in the 1980s and 90s in a big way.
70s, yep.
70s, and lost a lot of money and got out, and now they're
Yeah.
coming back. It's always interesting to see when that happens.
Yeah.
Yeah.
But it's great to see money flowing in
Yeah.
from those directions.
So fantastic. So I'll close this out now. So I think I captured some of the high things. We talked about the opportunities for investment are coming from everywhere. So public markets might be a tough time, but it's not terrible. It's a nice looking thing, and all the way from seeing new entrants come into the play to seeing the majors also double down, which is fantastic. I think it's really coming. We talked about substitution, about watching, about the long-term uncertainty here, about how it's going to play out. There's a lot of gap. We talked about risk and de-risking, and some friendly advice for our colleagues from Nigeria. We talked about the roles government play in this, and where there's resource nationalism, one end of the spectrum, to lowering energy prices, to creating jobs and bringing it in. And we talked about the world events and how that's playing out and how that's changing the landscape. And so it's great. And we didn't talk too much about ESG. I think we had another question at the end, but we talked about a lot about permitting and how to speed up permitting, how to get this there. But it's a very interesting world we're in, and it's great to see so many people playing in the financing of it. And I think we can keep going. But a huge thanks to the panel, and back over to you, Andrew.
Thank you very much to Louis and all of our panel. An absolutely fantastic